Welcome to the weekly macro update. Straight off the gate, we've got Monday. We had the consumer inflation expectations. They came in pretty much on par at this 3% here. And the consumer credit change. This one obviously is quite bad here. The over 11 billion, which is, I guess some could say, arguably not too much higher than consensus, but it's definitely higher than forecast. And it's definitely higher than previous. So we are still, as we thought we would, seeing some issues around credit. That's probably going to continue until rates are cut. No shock there. On Tuesday, we did have the Chair Powell testimony. Probably not worth listening to the entire thing. He pretty much said what he's been saying for the last few months. We need more data, and the jobs market's robust. Although his definition of robust and mine seem to differ quite considerably. He was asked a few funny questions from Mr. Kennedy. So if you're going to listen to any of it, probably just listen to those highlights. The questions were mostly centered around the jobs market, which is the part of the market which is the most concerning for most people. Other than that, not too much interesting on this day. We did have the business optimism index, which is in a nice uptrend, so we can see things are starting to look good from a business point of view, which is probably going to annoy the bears. Thursday is definitely the day that the entire market was holding its breath for. It's finally the day of the CPI print. Obviously, the market did move up for a few days prior to this data, suggesting that it was priced in to some regard. Makes sense given the profit taking we saw on the day after this data came out, and a bit of rotation into the smaller cap, more risk on assets. It seems like the market's finally expecting things to go with the. We'll talk a bit about it later, but the CME probabilities are really in favour of a cut in September now. So it seems pretty unavoidable at this point. The only way that I'd be surprised is if they chose to cut earlier, which I don't think they will do, judging by the numbers we had on Friday, which we'll talk about after this. But overall, the core inflation numbers were really good, beats all around, and we even had some disinflation in month over month. So ideally, we'd like to see that continue. The data today that wasn't so good was the initial jobless claims. Obviously, this has gone down, but given how good the CPI numbers were, it kind of washed out the jobs number. But like I've said many times, these numbers are looking very sus anyway. So I try not to give them too much credit, but they do move the market. We also had more speeches and whatnot. I didn't dig too much into the CPI numbers this week. I've been quite busy. Honestly, it seemed kind of redundant to dig through the nitty-gritty, given the numbers were so good anyway. Now we're on to Friday. Obviously, we know this data sucked. Pretty much all round, it was sucky. Unless we got really down into the sticks. But it didn't drop the market. In fact, the market did really well off the back of this news. The rotation continued to happen with the mega caps selling off a little bit for the most part, and risk on being a little bit more comfortable to move. I think this is probably because the CPI was so good yesterday. The market is pricing this in a bit as a one-off situation. I think the Bank of America did come out and say something along the lines of the PPI aggregate surprise to the upside, but the details used in the calculation of PCE were soft on net. So I think they expect core PCE likely to print a lot lower next month. So it shouldn't be so bad. Another driver, I think, as well, is that the banks had earnings pre-market this morning, and whilst they did sell off, the stock market price of those banks didn't reflect that they did beat earnings. I didn't listen to them all, so I don't know exactly each stance on guidance, but I'll catch up on that during the week and find out. But the banks aren't in trouble, so happy markets, I guess. Next up, the data that was worrying us for the last few weeks is still worrying. It's not gone away, but we do have some good news. If we put this on the monthly chart, we do seem to have hit a bit of a sticking point here. I'm hoping that this starts to come down a bit more, because I don't want to see this containerized freight index getting any spicier. Do not like it. Keep an eye on this one, guys. The dollar as well. Last week we talked about this purple trend line here and not wanting to see it break above that and start moving high to test these highs again. Glad to see that my expectation did become reality and we've broken below this trend line. We're now at this 105 kind of dollar sticking area. Obviously, we really want to see this continue to break down. For some reason, people are under the misconception that a strong dollar means a strong America. I think Trump famously really touted this in his last presidential term, and it's actually really bad for the economy. Um, it needs to break lower. Risk on can't do well with a strong dollar. Next up, we always like to have a little look at the oil. Obviously, my main concern was this breakout here that was going to send us on a aggressive upwards trajectory. There's a lot of resistance confluence here with these fib lines and some historical trends. I'm happy to see that these levels are holding price down and this breakout really hasn't got any momentum behind it, with the flows slowing down as well. I'm not convinced. I think this one's going to pull back down inside this trend line, which makes me really happy because that's what I really want to see. We don't want expensive oil. It's really going to push inflation. And it feels like we're well on the way to winning that battle at this point. So we just don't want this to run. More of the story here. Having a little look over commodities today, we can see lithium still down. Again, monthly and weekly. Love it. Great for Tesla. Agriculture, obviously this is a key driver of inflation, so it's smart to keep an eye on it. Year over year, still quite a lot of goods that are expensive, even though they are coming down for the most part on the monthly measure. But there's still some, obviously coffee. I think a lot of people probably keeping their eye on. Personally, I'm not a coffee drinker, but tea is, well, not as bad, but it's still going up. So it's important to keep an eye on here. But happy to see things still continue to come down for the most part. CME interest probabilities. There was quite a bit of jigging around given the CPI and the PPI data, but it looks like, I think this is probably high today because I updated this a few days ago, but we're still looking good for September. It's at this point it seems like a done deal unless some really shocking data comes out. As well, I like to keep an eye on the Trueflation data. Sorry, this is a free tracker, and it's mentioned a bit on my website. I think if you go to the free tools, I love it. It's more of a up to date view of where things are. I find that the government numbers can be somewhat lagging, so I think we're well on track. And I thought we'd get more of a bounce here, but we've continued to break lower, which is quite impressive. So I love it. We can take a little look at the fear and greed indexes for the market. I don't want to talk too much about these because I'm pretty sure you've probably seen all these splashed up everywhere lately, but we're still barely in greed. Pretty impressive, guys, given the fact that we're flip-flopping between making new highs on most indexes at the moment. No surprise, crypto fear and greed in the gutter after all of Germany's selling and Mt. Gox. I think hopefully that's done, unless we see some more countries start to dump. The indexes have been buying, so let's see what happens over the weekend. Are we going to get back to pumping the markets at weekends again? We'll find out. Just wanted to talk about a couple of other little things that I'm seeing out in the markets at the moment. I'm seeing a lot of people talking about the market topping, we need a crash, all that sort of stuff. It's not really appropriate to compare what's happening in the market today to a bubble, but look at the price ratio and the earnings ratio. This is a massive disparity. Companies were getting priced for amazing growth and it just wasn't there in the numbers. That's what creates a bubble. If we look at the numbers today, there's a small gap, but it's nothing historically that isn't, within average bounds. So from an earnings point of view, don't see a bubble. It seems all good to me. Obviously, we know the big tech's getting a little bit stretched in price, and some rotations do that will bring some breadth to the market as well. So I don't currently see a problem. Just maybe a little bit of cooling on mega caps is required because they seem to be holding up the majority of the market. But overall, not too bad. Um, did want to also show this chart. It just really showing that 85% of the S&P 500 is having expanding profits, similar to the chart above, just really showing that money is moving this market. Big companies are killing it. Smaller companies are getting beaten up because of bad credit, but that should improve when obviously rates come down, which is what my portfolio is geared towards. What else have we got to talk about? Basically just saying in this one that the median line, I believe, is the red. It's not. This is within average bounds. It's nothing too nothing too concerning either. Another chart basically just showing EPS is expected to continue to grow. The big companies will get bigger, guys. Money makes money. Just a couple more talking points to get through. Here I'm just showing a couple of seasonality charts for some indexes, just really saying that towards the end of the year, typically when we see larger moves for small caps and more risk on assets in the Russell 2000. We do see also this happening in tech and the S&P 500 heading up towards the Santa Claus rally. I think most people know what that means. The only other thing I wanted to touch on was obviously with my portfolio being quite focused towards the rotation event when it happens, we are starting to see that. This week we did have the biggest rotation that we've had since 2020, which I'm very happy to say my portfolio has done pretty well this month. Hopefully that continues. And this rotation has happened purely based on that CPI print. This isn't when rates are actually cut. I'm expecting this to continue. So that would make me very happy. All right, we're all done. If you would be so kind, give me a like, share, subscribe, and check out the rest of the updates that I've posted on the website at www.thecraftytrader.com. Hope to see you next week.
That's ISO. Rack it up, I gotta build up the bank to make me a safe house.